Hello, everybody. Steve showing. We're going to have a big weekend starting tomorrow afternoon. Everyone ready for it? Hello, Laura. DJ, how are you?
Morning, Dale.
Hey, Ryan.
Good morning, Dale.
Hey, Kay. Iceman.
How are we doing today?
We're doing okay. Steve stopped sharing, so let me take a look. We've seen
Dale?
some. Yeah, buddy.
I'm locked and loaded, huh?
You are?
Yeah, where's our t-shirts, Mush?
I don't know. Come to Greece and pick one up.
Hear that, Dale? We're all going to Greece.
Yep.
I'd love
better
to
do.
go. I'd love to go. So, taking a look at the euro, we're getting a little pop. Dollar. I got out of my short dollar position the day before because I thought if we couldn't close under 112. And then here we are. It looks pretty heavy to me, like it's going to attack it, like a rolling correction. Mid-dollar high could still be in. Aussie's acting great. Finally getting, a huge pullback in the end, but we did tag a little over 150 last night, right, Ryan?
Yeah, this morning,
Yeah.
Little teaser.
Yeah, but there's still nothing out of the BOJ. Joseph Yang, who's going to be our guest today, Fed guy, read, like what everyone else is saying is they're going to have to raise rates, and if they do that, there's going to be huge losses on JGBs that could cause a crisis. So I'm still asking.
He's just stating the obvious, right?
Yeah, and then
I've said it multiple times before.
Hey guys.
You need, hey Gregor. The only remedy that works long term is proper monetary policy. Everything else is just like using aspirin to fight, some kind of a serious disease.
Cancer. Yeah. I know cancer is your favorite metaphor, so go ahead. You could say it. All right. And actually, you guys know that guy Holger. I can't even pronounce his last name.
Shapix.
Okay.
Something.
Okay.
Yeah.
So Stell does, and I saw a tweet by him and said that the recent bond rout is not an inflation scare, but is about a dollar liquidity squeeze.
Oh, that was one of my arguments as well.
Okay, and that's what I've been saying. So I mean,
you add QT to rising yields. That's what you get in most cases.
Okay, so why can't they try intervention?
Well, I mean, so far the Fed and
benign neglect
told everybody that it's not the dollar is not really their problem right now.
Actually, it's their solution in a way. Imagine inflation is remaining extremely sticky above 8%, despite all the dollar strength that we've had, right? And currency strength is super important for a country that runs huge trade deficits, because it simply makes imported stuff, which are a lot more than exported stuff, cheaper, right? So imagine where US inflation would be if the dollar was falling. In my opinion, the biggest difference between, for example, the UK, that we now have inflation, reported inflation above 10%, and the US that has a 2% less inflation, is the strength of their currency. You flip that around, let's assume that the dollar was falling and the pound was rising. I bet you that US would have 10% inflation and UK 8% inflation.
Okay, I can't wait for that to happen. Let's flip it around already. And how does it flip, Steve? One day it's going to flip. Is it?
Oh yes, of course.
It has a bear market in equities hasn't made it flip. What's going to make it flip?
Well, let me counter that.
Worse
that
data
up.
in the US. Worse data in the US than anywhere else, or than
Okay, good
with the
point.
major counterparties. I think that's what is really going to flip the dollar around.
So we still get back to the best dirty shirt in the laundry.
Exactly.
Spiraling debt at
and
some point is also going to create that. At some point, it's not easy to time when that's going to be, just because the dollar is a world reserve currency. But spiraling debt is definitely going to be a main cause of some big bear market in the dollar at some point. I don't think it's going to be in the too distant future, but I don't think it's imminent.
Yeah, and
Let me flip the question, Dale. If
ahead.
there wasn't a dollar liquidity fears, would yields be lower with inflation where it is and with the Fed where it is?
No,
So
probably not.
you got a bit. I mean, you know, I'm not saying people are clutching the straws, anything like that, but
Yeah,
there's far more than one issue going on that's causing yields to rise.
I want you to respond to that guy's tweet and get a little debate
Stick it
going
up.
on.
Can I use a GIF?
Yeah, because he's saying it's a wrecking ball. And the Fed could continue whatever its destructive course,
Yeah,
and have some cover with a weaker dollar.
I don't disagree with that at all. I think the Fed has gone reckless the other way. They were reckless in not raising, and now they've gone reckless in raising too hard and too fast, and the economy hasn't had time to catch up with those hikes. And the higher and faster they go, the bigger the pains get.
As always, I'm going to disagree with this, right? In the sense that they've made a huge mistake in essence keeping rates at zero for the vast majority of the last 13 years. And at some point, that would inevitably lead to the need to hike fast and in an expedited manner. But the mistake is not what they're doing now, is what they were doing for multiple years that are forcing them to do it now, no matter what.
And now the other way, which brings us to even someone who worked inside of the Fed, Joseph Wang, is saying how people are losing faith in the Fed and the institution. And people are asking, why do we even need a Fed? And it's going to be interesting this weekend to be, I know Peter Schiff is no big fan of the Fed anyway. And
or central banks in general.
Yeah, and Danny was a central banker and left it. And we're going to be talking about that before policy of the Fed is the need and why, or if we even need central banks, and what's going to happen if they're not around. What would happen if they're not around? Most people and most developed countries say it's a necessity. What do you guys think? Could an global economic system work without central banks?
Much better than it does at the moment, in my opinion. I'm 100% convinced about that.
So dissolve them.
Wait. Hey, good morning. And
hey,
this is where I got to.
Are we going too far, Blake?
I'm just sitting back listening, but Steve, I strongly disagree. I mean, okay, let's go ahead and elevate your favorite asset class, Bitcoin, and let's just say there is a global currency. Let's say there is a global currency that is not controlled by any central banks. And then the market goes into panic mode. Then what?
That's right.
Then what?
That's right.
There's no levers to push. The shit just hits the fan. I mean, what do we do? Do we all just
that's
like
a major reason. That's a major argument.
Yeah,
at some
point.
Yeah, the projection problem with your thesis, Blake, is that you're projecting the fragility of our financial and system and our economies that is mostly due to all the interventions from central banks in a new world order that central banks wouldn't be there to save the day. And just a reminder, for example, the US flourished without a central bank. The Fed.
No.
The
There were
Fed was
panics,
created.
the panic of 1908.
Your
There were
argument
many
is basically
panics.
saying there would never ever be a crisis again.
Oh no, that's not my argument. There would be.
Okay, if there is a crisis, then you get the herd mentality, no matter what. Then what?
Then what? Then the market
then everybody
forces
shits the bed.
Then the market forces discipline. For example, if you know that you have to make the right choice having to do with a financial institution to park your money, you're actually going to do your due diligence in which financial institution, I'm talking about a private bank at the moment, is actually worth putting your money in. If you believe that no matter what you choose, which bank you choose to put your money in, you don't have to worry about it. So you might as well do the most reckless choice that will yield just a fraction of a percentage more, just because if things go wrong, the taxpayer is going to bail out your money, right? Then you induce all this moral hazard, wrong choices that has brought us to where we are. And where are we at the moment? With the vast majority of economies in the world being completely bankrupt. Right.
Okay, wait. Yeah. You know what? I'm sitting here looking at, look, we got 30 minutes to talk about actionable ideas, and you and I could go around for like literally days. I think that's the most ludicrous thing ever. And we should agree to disagree because
sure.
Yeah, I just do not agree with any of that. But anyway,
all right,
but let's talk about actionable ideas. Let's talk about stuff that's going to make our audience actually money today. Because that theorizing about that is not going to do that.
I agree with
100%. So let's talk about something that actually you guys can actually chew on. Let's talk about what's happening in China. From what I'm understanding, this happened really late. I was just heading to bed. The Aussie you can see is ripping higher. Ripping higher. I mean, it bounced, 60 pips or whatever off some support. But it looks like there's some speculation that China might actually relax their COVID policy finally. I mean, is COVID even still a thing?
Yep.
They are at 4-month high COVID cases in China.
Oh,
well,
okay.
they have
50 what is that?
Cases.
20,
55.
I mean, seriously, we gave up on COVID back in 2019 here in Arizona, so I have no idea what people are talking about nowadays. But anyway,
it's a flu, Blake.
It is. Oh, okay, all right.
It's just a cold or a flu with long-term effects.
The fact of the matter is that this is the market's having it's kind of responding to it. But I gotta ask this question because I was reading something earlier about what if China really comes back online? We're starting to see like some disinflationary pressures build in the market. Like, what if China really just turn the lights back on? I mean, wouldn't we just feel like, wouldn't that put the global economy in like kind of reverse? Like dealing with inflation, and now we got to deal with disinflationary pressures as everything comes back online. I don't know. That's just me thinking out loud after reading that article.
More demand, Blake. More demand for oil. Everything. I see that you tweeted the Joe Biden trade yesterday. All right, where you faded the SPR release. So if China reopens here, that's even more of a bull case. They really have their imports of oil have been down because of lockdowns, and if they reopen, look at you'll look at oil and you'll look at copper and all the things that China consumes that they haven't been. Here's the look in copper. Maybe one more low.
Sorry, I was just grabbing the charts. I'll pull up copper right now. That's the US dollar CNH that I think we should all be looking at, and I want to hear from the team. But let's take a look at copper. What you're saying here? Yeah, I mean, could we really here? Let's delete all that really quick.
Yeah,
I mean, could we get a lower, a higher low in copper?
Yeah.
And you get a lot of people that have been really leaning into the copper short trade, expecting, oh, here's a pennant. Oops.
Yeah.
Here's a pennant, and everybody's short, and all of a sudden China comes back on, and next thing you know,
we're at $4.
Dude, I mean, I wouldn't want to be short copper. I mean, here's the thing: if you don't get below this 323 here, and then you start taking out this resistance, I mean, you gotta draw the line somewhere, right? If you're short copper right now,
and S&Ps,
and S&Ps, I mean, look, we had yields, and we should talk about all these things in more detail, but we just have the bond markets looking to pivot right now. Oh, did I say pivot? I meant Fed. No, I mean not Fed pivoting, but you know what I'm saying. Anyway, you got the yields. Take a look at the 10-year. I mean, we're showing a bit of a reversal here at the 161% extension. 30-year, we're still ripping here, but here's the bond market, hitting that 161% extension. What if we see yields turn? And I don't know. So there's a lot of things.
Actually, look at the HYG. You had it up there, which is really more important for the stock market.
It really
They
is.
don't look as bad. They don't look as bad as treasuries.
No,
they look better.
Speaking of which, Sterling's hitting highs right now. Did Liz Truss get kicked out? Is she done?
There's a statement at 1 o'clock. It's rumored that at 1:30, sorry. So in 14 minutes. There's strong rumors that she's off.
There's a rumor that she's what?
Gone.
That she's going, resigning, whatever.
Okay, we're going to come back to that. But really quick,
Dale, in history.
Dale, based on what you were just saying, the HYG, this is really, as you pointed out, and I think it's a really good reminder. And I'm glad you brought this up. If this is hitting lows, I'm definitely running for the exit. That's when you have the high yield, the high yield bond ETF moving down, you just gotta get out of the way. But you're right, it's basing here. It hasn't broken new lows, and you're not seeing stocks hit new lows, even with yields hitting highs. And this is a conversation that I was having last night with Chris Weston over at Pepperstone. Is this very thing, and this is why you start looking at the dollar and you're like, well, why isn't the dollar hitting new highs? And especially if we start to see yields, actually pull back, this dollar index. I mean, we have the throwover, and we've talked about all the technical reasons why the dollar can actually stall here. But what if yields actually start to come down? We will see a reversal in a lot of asset classes. All right, sorry, Ryan Kman, I'd love to hear you guys' opinions about Liz Truss. She's out. So do we buy Sterling, or do we short the hell out of it out of uncertainty because we don't know who would take her spot? What do you guys think?
Yeah, it's very messy at the moment. Cable's getting a little bid on, so it looks like if she does go, then
the knee jerk is to buy it.
I wouldn't buy it because I don't know. It's going to be a short-term reaction. I put a bit of a note in the chat room earlier about it. The problem is, and trying to be as succinct as quick as possible, the Conservative Party, the ruling government, is fractured. Whoever comes in is going to face the same sort of stuff as Truss. So if it's Rishi Sunak, which may be market positive, he'll face all of Boris's old pals who won't like him, and they'll do exactly the same to him what everyone's been doing to Truss. Until the party becomes cohesive and there's a member that can unite the party, they're fucked. Likelihood of a general election, whoever comes in as leader in the interim or whenever is going to face the same problems. It won't be solved just from Truss going.
I'm sorry, I didn't hear anything you said. Did you say they're pucked? Pucked?
Yeah.
Like a pucked?
Yeah, that's what I heard as well.
Okay, I just want to make sure. Yeah,
Ryan,
this is a PG show there, Ryan.
Ryan, I have a question for you. I really don't understand what's happening. I mean, as an outsider with the UK at the moment, it's like, so now every leader that's going to be coming on is going to be facing like every single decision from day one is going to be like a vote of confidence. I mean,
exactly? You can't keep a leader for more than like a year.
How exactly is that supposed to work? And I'm not joking around it. I mean, it's an honest question. How exactly can a country be governed like this?
It won't be. It won't be. We'll go to a general election, and then either Labour will get in because everyone will go, I'm not voting for Conservatives. So Labour will get in, which will be really market negative because they are heavy taxes. If you got money, you're going to pay for it. Very investor unfriendly. So the pound will suffer on that. Alternatively, and what's most likely is probably a hung parliament. So we'll have, no overriding government. There may be coalitions, and if that's Labour and the Lib Dems, again, that's negative. It's screwed, and it's screwed if you've got someone like Steve who comes from Greece and their political worries saying he doesn't understand what's going on in the UK,
or us here in even the United States. We look around and go, man, we're screwed up, but man, those guys are really.
I mean, I thought that's impossible, but your political scene has become a bigger drama than the Italian one, and I never thought I would say that.
Oh,
yeah,
my goodness.
exactly what's happened.
Thank God you guys left the EU. Holy cow. All right. So, well, looking at the sterling, I mean, I'm just technically looking at it right here. I mean, we still have a bull flag. And I think technically while we're above 111.22, which is this low right here, like if I was, if I was thinking, I'm okay, we're going to get a relief rally if Truss is out of here. I just don't want to see it below here. If it gets below there, I'm out. Like,
and you got,
and that's good. I mean, because if you think about it, like from a risk reward standpoint, let's just do the math really quick. Let me go over here to ForexAnalytix. Let's just say 112.81, and I want to my stop is 110.99 because I don't want to risk below 111 basically. But let's say we get a squeeze and we squeeze up to, and we're not going to say we're going to 120. Let's just say we squeeze past this resistance and maybe past the like 115 level. Maybe we get towards this, previous descending trend line, which takes us to about 117. I mean, that from a risk reward perspective, I mean, that's not, let's just say you're trading $1 million in currency. I mean, well, that's probably a lot for most people. Let's just say you're trading 100,000 in currency. I mean, you're risking 1,600 to make 3,700. You got a 2-to-1 risk reward ratio here, 2.3 to 1. Or I mean, that's not bad. If it goes a little further than here, you're going to start to run in some issues. But I mean, look, if we really think there might be a little pop and a squeeze, it's not a bad trade. Not something. I don't think it's too bad here. All right. Well, thanks for the update. Kman, you have any other opinions about the UK situation there?
No, I'm having the same question marks about what's going to happen later. I can't trade it. I can see why the market is buying back sterling right now if Truss goes, because of the whole scenario. But I really, it's clutching straws to know what's going to happen with sterling later on.
Clutching straws, is that like clutching your butt cheeks?
We are on
in a bad trade,
an open face show here, so I'm not using these kind of words.
I know the profanity that gets thrown around here is like, you guys think that like Ryan thinks everybody's a damn sailor, for crying out loud.
I think Ryan spends too much time in the soccer field.
I know, he's like, I guess if I was a West Ham supporter, I'd probably curse a lot too. So there.
What's a damn sailor?
Sorry, dude. All right, so let's talk about the dollar yen brushing up against 150. Let's say, and for argument's sake, let's just say I'm right here. Let's say I'm right with yields and bonds actually start to bounce and we see yields come down. Does the Japanese yen respond to that? Kman, you're the yen man. What do you think?
Okay, I'm going to answer you. If, as you hope, the Fed starts to cut rates, dollar yen will probably go down a bit.
They what?
I mean, no, but
in what world are they going to be cutting rates? Did you just say they're going to...
assuming that? What is in front of us is that Japanese investors are still apparently buying dollar yen, and CTAs are buying dollar yen, and there is very little fundamental reason to be long yen unless the dollar turns. And is something that I keep banging on about. If the dollar turns, then dollar yen will likely turn. But for the time being, and I
give me one reason to buy yen. There's got to be a reason. Give me one. There's got to be
yen.
I know
one.
Yeah, why would I buy yen? Give me at least one. I know there's got to be one.
I can give you one Because
Okay,
I
I-
want to
you
be a
like-
I mean-
masochist.
K-Man, you like Asian women. We buy yen. Is that it?
You're
No,
going
give
on
me a
holiday
reason.
to Japan, you buy yen. That's your only reason.
Yeah, okay. No, I mean, jokes aside, guys, there's got to be, there's got to be a reason why we'd buy yen.
Peaking
Is
yields.
there?
Peaking yields.
And
Yeah,
like I said,
that-
jokes aside,
That's
is
it.
there a reason really to buy yen?
Yes.
Well, yes, what you showed in the bond market.
Yeah, exactly. If the dollar turns around, that's what I'm saying. If and when the dollar will turn around, you can start to buy yen, but then you can buy other currencies as well.
I'm gonna be the party
Fundamentally
pooper.
speaking, Steve, can I just finish?
Yeah.
Fundamentally speaking, right now, as it stands, with the Bank of Japan, with the government injecting stimulus, with all assets outside of Japan performing better than inside of Japan, there is zero reason to buy
Exactly.
yen right here and now. Zero.
Exactly.
Zero.
That's what I wanted to say. I think that before somebody buying yen, you first need to have concrete evidence that all of that Kman mentioned somehow is changing, and then consider buying yen, but not before, just because you want to cross your fingers and hope that you might be very lucky to get the timing right out of, just pure gambler's luck.
Yeah, and
Buy
okay,
yen now,
so
you're betting on an intervention. That's as simple.
I got let me and just so you guys know, I'm actually short some dollar yen not too far from here, and it's really small. It's like I'm playing it more for the risk reward reversion type of trade, but I know where I'm wrong, and if I'm wrong, I get out. It's no big deal. But let me argue my own trade, argue against my own trade. What if markets start to rally and we start to see some, the S&P recover here, and we start to rally back towards, let's just say the 50 DMA, 200 DMA, we get a recovery back towards 4K. Doesn't the carry trade even get bolstered more? I mean, and then you see, like, look at this euro yen. I mean, doesn't this euro yen really start to break out? I mean, we're already breaking out. I mean, but doesn't it break out more? How about the Aussie yen? I mean, could you really, and these are monthly charts. I mean, could you argue that the Aussie yen could theoretically trade up towards 105 to 110? You get the New Zealand yen, I mean, again, this is the carry, right? You carry these higher yielding currencies and you sell yen, and they go further higher.
That's exactly what I've been saying. The MOF in Japan is not only fighting dollar yen. MOF in Japan is fighting all the currencies barring China right now.
Right. And again, guys, this is I'm arguing against my own trade right now, and I'm not short all these other yen pairs. I just sold some dollar yen as we're close to 150, but like I said, it's small, and I know where my stop's at, and if I get stopped out, no big deal, But look, if risk does recover, we could really see, the carry trade really explode, because the carry trade's been. As we alluded to back in 2021, it is going to be the trade of 2022. And the carry trade by far has been the best working long side trade of all of 2022, hands down, because everybody's gotten clobbered but the carry trade, right? So imagine what happens if the market actually recovers. Those are going to explode, and that you have to think about. So look, we're 2 minutes away from Dale having his
we have
his
data
interview
too.
Look at who woke up Stelios. Thank
No,
God.
it's-
Stelios pops in because I gave him such a hard time for
He's the only
forgetting
polite
that we
guy
had
that doesn't
data
interrupt.
the other day.
Yeah.
I just wanted to see if Steve is still coming to your place or not.
He is. All right. So we have Philly Fed initial jobless claims, and that's coming out here momentarily. So thank you, Stelios. Good morning, by the way.
Good morning.
I just want to mention really quick before we have just a minute. Joseph Wang's coming in less than a minute. So if you guys haven't registered for the Trader Summit event, we're giving away, I say we, with the Trader Funding Program, we are giving away two $250,000 assessment accounts. There's worth $2,500 each, and we are authorizing on a weekly basis. We're authorizing payouts for our traders that are trading our money now. So this is pretty cool. So check it out. Get registered for the Trader Summit event. Joseph Wang, who will be here in just 1 second, he's going to be here speaking. Let me get over to the charts really fast. Let me put on a 15-minute chart.
We have Philly Fed and jobless claims.
Yep. We have data
Sky
coming
News
up.
just saying that Liz Truss is about to resign. That's probably
Oh,
speculation.
God.
Wow, that is going to be the short. How is she? Will she hold the record?
Yes.
Probably.
I
Probably,
think so,
yeah.
yeah.
Okay,
I
data.
want a
Let's
Philly
see.
cheesesteak,
Sorry, guys. I'm just moving everything.
not a
over
Philly
here.
Fed. Give me a
What
Philly
is- shit.
cheesesteak.
What's the data? So,
Oh.
data is Java's claims a little bit better. Continuous claims. Oh, Philly Fed.
Philly Fed's
Philly
not
Fed
good.
manufacturing a
Weaker.
lot worse than
Dang it,
expected.
that's gonna keep a hawkish Fed. Wah, wah. Wow, the dollar's
Manufacturing,
actually,
though, still tanking.
yeah, and the dollar's actually weakening. As a
Employment
result.
in the Philly was strong, 28.5 versus 12 prior.
Huh. So what do you figure? Gosh dang it! Stop.
Price is up as well.
Stupid chart. So what do you make of this move here, and why is
Keeps the Fed hiking.
yeah, but why is the dollar weakening? That's the question.
I think just noise, Blake.
Is it like white noise?
I wouldn't pay so much attention to it. You know me, I don't track very, very short-term charts because many times you just see noise.
Yeah, it's like farting noise.
Come on.
Oh my God! And your
like,
problem was Ryan before.
Steve's going to be sitting next to me.
about
Steve's
the
coming in
trash
from
talk.
Greece next week, and he's going to be sitting right next to me. I cannot wait to wake him up at 3:45 in the morning.
Yeah,
here,
that's true.
And I'm going to say, "Get up, sunshine." right.
Although, you'll probably not have the satisfaction of seeing me being very tired because I remind you, due to jet lag, I will probably be waking up on my own practically at that time even.
Do
Sooner.
not rain on my parade, Steve. I'm having
Yep,
a good time
I am
thinking
raining on
about
your
it.
parade.
All right. Hey guys, I want to say thank you, team, for all your insights today. And look, the dollar continues to weaken, even with that weak data. So watch yields today. I think that's a big one. Watch yields. Watch China. What else should we be watching, guys? Anything else on your radar?
Base.
What? Wait, I heard Ryan said West Ham. What?
Sky News for this presser.
Okay. All right, guys. Hey, Dale, have a great
I want Ryan
interview.
to be the prime minister of the UK.
They couldn't pay me enough, Dale.
Huh?
I think we should be watching. We should definitely be watching what's happening in the UK. This clown show we got going on. So no offense, guys. Dale, have a great interview with Mr. Wang. I love Joseph.
Okay.
He's like the guy you want to be listening to in this tumultuous environment. So glad you have him here. We look forward to having him on the Trader Summit event this weekend, and make sure you guys register. It starts tomorrow. So we'll see you there.
Okay.
All right, Dale, it's all yours.
Thank you, Blake. Thank you, team. Welcome back, Joseph.
Oh, hey Dale. Hey Blake. Hey
Hey.
everyone. Thanks so much for inviting me. It's a pleasure to be
Good
here.
morning,
Can you hear me?
Joseph. Good to
Hey,
hear
Joseph.
Great to have you back, Joseph.
Okay,
And,
Dale and Joseph, behave. We don't want you to give out too much today, right? Hold some back for the event.
all right. Well, this is a rehearsal. Okay. So, Joseph, great to have you back. I'd like to start with when we first met and I started being aware of your work. At that time, you were talking about the great steepening, right?
Yes. Looks like we
Okay.
inverted since then.
That's what I mean. Okay, it turned into instead of the great steepening into the unexpected inversion. Could there still be a great steepening, and it happens when rates go the other way, that there'll be less confidence in the long end, and that's when the steepening takes place?
So this is how I'm thinking about the shape of the curve going forward. So
Okay.
one thing I also noted earlier in the year is that the 10-year would go up to 4%, and surprisingly, it did. So I think of 10-year longer dated yields as really just determined by supply and demand. And if you looked at the supply and demand dynamics, it was really clear that the longer yields would have to go higher, and maybe
Right.
significantly so. So at a high level, the supply dynamics are just incredibly bearish for the treasury market. So right now, the US government is projecting about $1 trillion in issuance every year forever. And just for some context, before COVID, they were issuing about $500 billion a year. So it's much higher pace. And if you go back 10 years, you actually have people who would worry about things like the deficit, but all those people, they're gone now. So we're full speed ahead and we're just issuing a lot of debt. And you add on top of that QT. What QT does at a high level is it increases the amount of treasuries that the market has to absorb. So you got the treasury. So you have the treasury issuing $1 trillion a year, and you also have QT issuing adding several hundred billion as well. So with all that supply coming online, and the marginal buyer until recently was the Fed and the commercial banks, and so they're all stepping back. And so based on that, it seemed to me that it was quite clear that we would have higher, longer dated yields, and that has come to pass. We're above 4% now. But I think we're at this place now where I'm a little bit more unsure if we will continue to go higher. Now, again, those supply and demand dynamics. Oh, well, Liz Truss resigns. Okay, just breaking headline just for you guys.
Yeah, that's what's happening there. So I'm wondering, are we any different
so I'm not finished
than
yet.
the UK?
So usually these supply dynamics would continue to suggest that yields will go higher, but there are other things to consider as well. When your yields go higher, what that really means, another way you can look at it is that people who own these assets, they're losing money. And when they lose enough money, they eventually get things like margin calls or they have solvency issues.
Yeah.
And we see that happening. We saw that happening with the pension funds in the UK.
Right.
So
is
in
the US
UK,
any different?
What happened? So in the UK, so Dale,
is the US any different than the UK when it comes to that?
Let me finish and I'll get to that. So what happens is that eventually, when the yields go high enough, then people have some solvency issues and then bad things happen. The thing about the bond market, though, is it's globally connected. So when you have US yields rising, it pulls up the yields in the rest of the world. And, well, on the same way, though, you have supply and demand dynamics were also bearish for bonds throughout the world. So eventually, something somewhere cannot withstand these higher yields and things snap. And then the authorities come in and they try to restore order to the system, which is what the Bank of England tried to do. So the Bank of England but if you'll notice when the Bank of England stepped in and they started buying, that also put downward pressure on US treasuries as well, because the global bond market is connected. Now, going back to your question, Dale, the US is not super different, but I think our financial system is a lot stronger. The way you can see this is if you look at a basket of, let's say, US bank stocks against European bank stocks.
Good
so
point.
If you look at whatever happened since the great financial crisis, well, all our US bank stock, the stocks of, say, JPM City, they've all surpassed past highs and then, gone higher. The European bank stocks have not done very well. If you look at DV, it's over the past few years, it's just kind of gone nowhere. So they are a lot weaker. And if you hear market chatter about things like CDSs of DB or Credit Suisse, it's all the same. So they are in a much weaker position than the US is. So as global yields go higher, I think that even though the US is not, they're a fault to the US is relatively stronger. And because it's relatively stronger, when something happens, when something breaks, it's probably going to be in the Eurozone or somewhere else that will force their authorities to act. And so that actually means that there's less, less impetus for the Fed to act and also downward pressure on yields. So when I see this, even though I think that the supply and dynamics dictate that, yields will go further higher, I think somewhere along the way, the authorities will step in and kind of either slow this down or stop it, kind of like what they do in Japan.
Okay, so you're talking about that on one of your tweets that there'll be a central bank put on bonds because of solvency issues.
Yeah, exactly. That's right.
Okay,
so
go ahead.
Yeah, so for example, so let's say you're a big asset manager, like a pension fund. You have assets and you have liabilities. When the bond yields go higher, that's your bond prices going lower. If you have a little bit of leverage, and if you're a financial sector entity, you always have leverage, right? If you're a bank, you have leverage. If you're a hedge fund, you have leverage. Very few big players don't have any leverage. That mismatch between your assets and your liabilities, and not everyone has to mark to market, but some people do. That might create some pressures. So we have this. So people talk about the level of the debt in the system is very high. I look at it as that's the potential losses that would happen if yields continue to go higher. That is to say, the prices of debt continue to go lower. You're basically taking money out of the financial system, but the losses are unevenly distributed, such that perhaps someone is not able to bear these losses. And when that happens, they'll have to sell to make their margin calls. When they sell, that makes the asset prices go even lower, and perhaps other people will have that same problem as well. So that's the fragility that I think we see, and I think the authorities are aware of right now. So that's
Are they going to come in? Is the Fed going to come in? And before we get to that, you talk about us being stronger, yet at the same time, there's no central bank cooperation. Yet at the same time, the Fed is doing swaps with Credit Suisse, which is not a U.S. bank. So if the crisis happens in Europe, the Fed's going to be involved anyway. Isn't that going to be more costly than coming in with a solution like the bond put that you're talking about? And isn't there a solution with the dollar being the wrecking ball? I've been talking about this for a while, to stop the ascent of the dollar, which may be stopping on its own, but to have some type of concerted intervention, because isn't part of this bond problem a dollar liquidity squeeze?
So that's a lot there to unpack. Let's go by it one by one.
Yeah.
So the Fed is, in a way, the central bank of the entire world because of those swap lines that you mentioned, Dale. So let's say that there's a bank somewhere in Europe or maybe in Japan who has some dollar liquidity issues. Now, if a bank has dollar liquidity issues, usually what happens is that it goes to the lender of last resort, the central bank, for an emergency loan. But if your issues are in dollars rather than your home currency, well, that's a problem, because the Bank of Japan or the ECB or some other foreign central bank cannot print dollars. So that's where the Fed steps in. The Fed has these swap lines where what it does is it acts as lender of last resort for basically the global banking system. So if that bank in Japan or in Europe suddenly needs a dollar loan, what they'll do is they'll borrow from, let's just use the example, a French bank. The French bank would borrow from the ECB, and the ECB would then borrow from the. So in that way, dollars flow from the Fed to the ECB and then to the French bank. Now, what we see right now happening is that the Fed has some loans to the Swiss National Bank. So presumably there are some Swiss commercial banks who need dollars. So the Fed is lending to the Swiss National Bank, who is lending to the Swiss commercial banks. Now, some people think that this may be a sign of some stress in the system, but there's another way to look at this as well. This has happened before, and Zoltan Pozsar, who is one of the preeminent strategists in this area, a strategist at Credit Suisse, has written about this in the past. Now, one thing to note is that in the past, what has happened is that these small Swiss banks, well, some of the smaller Swiss banks, what they do is they borrow dollars indirectly from the Fed, swap them into Swiss francs, and then deposit those Swiss francs at the Swiss National Bank to earn interest. So it's not that they need dollars. What they're doing is an arb trade. So usually around, let's say, the fourth quarter every year, there's some pressure in the funding market. markets.
Okay.
This has to do with regulations. So when that happens, some banks would try to take advantage of the cheaper dollars that the Fed provides and use that to just make some extra cash by arbing interest rates. So it's not that they need dollars, it's that they just want to earn a little bit of extra return from doing this trade.
So is the dollar not being appropriately labeled when it's being called the wrecking ball of the global economy?
So the dollar is definitely exerting some very strong deflationary effects on the world. And the mechanism through which this acts is the fact that there are many foreign corporations who take out loans in dollars. Now, let's say that you're a Japanese corporation and you borrowed $100 million US dollars. Okay, you have a $100 million US dollar loan, but then you see your currency depreciate from 100 yen to, let's say, 150. Well, that means, and if you're earning money in Japanese yen, then that means your US dollar loan just became much more difficult to pay off. Effectively, your dollar loan became much more expensive. It grew a lot. Now that makes it difficult for the Japanese company. It's equivalent to having, you can think of it as if you borrowed $100 million and you end up owing $150 million because of the currency difference in effect. So that obviously is a drag on that corporation, makes it less likely to be profitable, to expand, and so forth. And that happens at a global scale because there's a lot of dollar
emerging
loans taken by
market debt, etc.
But I think there's two things you have to keep in mind as well. One is that oftentimes these corporations, they do hedge their exposure, so they don't really fully bear the brunt of this. And the other point is that if you're a company taking out dollar loans, usually you also have dollar revenues. So for example, let's say you're an oil company who took out dollar loans. Yes, maybe you're based in the Middle East, but your revenues, your income is also in dollars. So you're hedged that way as well. So not everyone is hedged, but I would say that it is not as bad as it appears to be.
Okay. All right. So a weaker dollar, would that take some of the pressure off this liquidity squeeze that we have going on in global bond markets? And if the dollar continues to move to higher highs, does that exacerbate what we have going on here with your worry about solvency? And when will the Fed come in with a put on bonds? We're getting close to some technical levels where there could be a recovery. Are we near the time where they're going to come in here and try and stabilize the bond market like the BOE did? Is that the put you're talking about, a central bank put on bonds?
Yeah. I'm going to have to defer to you guys about the technical levels. I sense my sense is that they are getting concerned, and that there are some tools that they can do to kind of slow this down. But again, my thinking still was that the ECB and the Bank of England and maybe the Bank of Japan should be a lot more worried. And when they do something, the Fed has to do less because the global bond markets are connected. If they can slow down the rising yields elsewhere, that also slows down the rising yields here in the US. Now, if they wanted to stop the rising yields, there are a few things that they can do. Most obviously, they could do some form of QE. I think that's very unlikely. They could do some form of yield curve control where, let's say, the Fed says, Japan? I'm willing to. Yeah, but except one where it's less of a binding ceiling. For example, let's say that the Fed is willing to buy every 10-year treasury that yields above 5%. So setting the cap at 5%, such that it's more like an emergency liquidity facility rather than a binding cap like it is in Japan. I think that's sometime in the future as well.
Why don't they just sell dollars and make the dollar the sacrificial lamb as a band-aid for this emergency?
Because, so I think it's really important to make a distinction between the spot price of dollars and dollar funding rates. So if you have a squeeze for liquidity for dollars globally, it doesn't actually manifest in a dollar spot price. That's not how funding happens. If you're a corporation abroad and let's say you're a Japanese corporation, again, the $100 million loan, suddenly you can't pay your loan back. What you try to do is you try to roll it over. What you don't do, well, maybe you could default to what you don't do is you take your last liquidity and you go, try to buy everything in the spot market. That doesn't make any sense.
Okay, so like what the BOJ did with spending 1% of their reserves was, and they haven't backed it up. We're above their first attempt at intervention, but couldn't concerted intervention between BOE, BOJ, and the Fed work like it did in the Louvre Accord or the Plaza Accord?
I could, but that misunderstands the Fed. The Fed wants a stronger dollar, and they've been very open about it. If you listen to Chair Powell as speaking before the Senate and House committees, he'll tell you straight up that one of the ways that monetary policy works to get inflation lower is to strengthen the dollar.
Right.
So that's what he wants. There's no reason to do no Plaza Accord if because they don't want a weaker dollar, right? So so they this move in the dollar is blessed by the authorities. So you don't.
But
really
if
have
you
to,
look at the bond chart, they're the opposite. Look at this, and then look at this. So if you want to stop this, why not stop this?
Because you don't want to stop either. You want yields to go higher, and you want the dollar to go higher. That's how monetary policy works to decrease inflation. So
so they think they could do that without creating the solvency issues that you're worried about.
So I think they're beginning to get worried because they don't really know where that point is.
Yeah.
So far things are going, I think, as they expect, and you can hear that in their speeches as well.
Yeah.
They are happy, and Jerome Powell is also very happy that the equity market declined a bit. But eventually, you can't keep rising forever. There's a limit there, and that's what I'm talking about. There's a limit as to how high yields can go before you incur some very serious financial stability issues. And I think we're getting close to that point, which is why I think that yields are
close to peaking,
close to pausing. I don't know about peaking, but close to pausing. I think the bigger picture is yields continue to march higher, but maybe we have to pause it a little bit. We've gone straight up for a while, haven't we?
Yes. So this brings us to what you're talking about now, Joseph, and a lot of institutions have lost credibility, and you're talking about, most Americans don't believe that Congress is functional anymore. The medical system, just a lot of institutions that we've relied on for generations, which includes the Fed. And you're beginning to worry that people are asking, why do we even need a Fed? And that their confidence in the Fed is decreased markedly. So the Fed really needs to pull this off, because if we have a very hard landing, don't you think that's only going to accelerate the mistrust and people saying abolish the Fed?
Yeah, I think so. So politically, there's actually, you raise up a really interesting question about confidence in the Fed. So if you're the Fed and if you're a PhD economist, you think that a lot of the reason inflation has been low in the past is because of confidence in the Fed, because the Fed believes in something called inflation expectations, which is not unreasonable. So the thinking is that if people expect inflation to be, let's say, 10% next year, they'll go out and they'll buy stuff today. And if they do that, that makes inflation higher because everyone goes out and buys stuff today, pushing prices higher. So a big reason from their thinking that inflation has been low is because people expect inflation to be low. And why do people expect inflation to be low? Because, well, the Fed is going to do its job and keep it low. So that's kind of how they think about inflation expectations. The funny thing is, though, that people who do these surveys to the broader public and ask them, so, what do you think about the Fed? Do you have confidence in Fed? And what do you think about inflation? And the majority of people have no idea what the Fed does. And so confidence in the Fed really can't be, you can't say that inflation is
how
low
can you
because
have confidence if you don't know things exist?
Exactly.
Right.
So
right.
that's kind of, I don't know, that's, so there's a big gap between how academic economists think about the world and in my view, how the world actually works. And the gap is really wide. And so they have all these bizarre ways of, thinking about the world. But yeah, so I don't know if Fed confidence is all that important, but the public definitely does not like high inflation.
Yeah.
And there are people who don't like the Fed. And I think we'll use this opportunity to try to take away the Fed's independence. And we see whispers of that already, and we see whispers of that in the UK as well. And it's not unreasonable too. So we gave the Fed independence because we wanted it to be able to do its job without political interference. We were afraid that whichever party is in charge would use the Fed, who has a money printer, to further
Right.
their own games, right? So
Right.
we don't. That's why we gave the Fed independence. We want them to be above that and take care of inflation, or is another way to think about it is the value of our currency. But the Fed has shown that it's not able to do their job. Inflation is 8%, and maybe it won't go down to 2% for some time. Now, if the Fed is not able to do its job, then maybe there's no reason to have an independent Fed. So I think going into the future, we will have people who will try to take that independence away, and as justification say that the Fed is not doing its job; it needs to have more oversight, and that could be something in our future. And if that happens, I think inflation will probably get much worse, because the trend in politics seems to be to spend a lot. So to win elections, back then people would joke that eventually people would realize that you could just vote yourself money, and then that would kind of be the end. And we're kind of there already, it seems. And taking away the independent Fed accelerates that transition. But that's something I think still in the future, not imminent.
Well, I tell you what, I'm rooting for Jerome Powell to pull a Sully and land that aircraft on the Hudson safely with all of us on board.
I'm a fan of Jerome Powell. I think he's doing the best he can. So I hope he does well as well.
I'm a fan of Joseph Wang. And if you want to learn about what is so esoteric, and I talk about it, but it's like me talking about Elliott Wave. I'm an amateur. If I didn't have a chart, I wouldn't be able to steer my ship. So if you really want to learn the nuts and bolts of the Fed, check out Joseph's website, and you could follow him on Twitter at FedGuy12 and come listen to him this weekend. I believe Kman's going to be interviewing Joseph, and really appreciate your time. Every time you're here, you edify me. I learn from you, Joseph, and I'm sure that our audience does too. And here's to solvency.
Thanks so much, and I really look forward to this weekend. I think it's going to be great. Very impressed by your program. It looks like you got a really good roster of people, and I'm flattered to be among them.
Yeah, great to have you. Thanks for agreeing to it, Joseph Wang, everybody, and thank you, Joseph. I'm all for them coming in to stop yields, and me, I want a dollar bear market. I want a dollar bear market. I think that a weaker dollar would go a long way to kind of calm things down. So thanks for answering my nagging question about the dollar. I appreciate it.
My pleasure. All right, I'll see you guys this weekend then.
All right, my trading warrior brother, Joseph Wang. Don't forget to catch him this weekend and go to his website, fedguy.com, and learn about, what happens on Jekyll Island, right? And that's a wrap, everyone. You could join the team in about 17 minutes on the morning edge. Good hunting the rest of the day. And remember, don't just count your pips, count your blessings. Adios. See you for TGIF tomorrow. Thanks, Joseph.